You are going to see a crack in the bond market.
America's debt, it stands at $36 trillion. That's the debt, $36 trillion. That's what the U.S. government owes.
The Congressional Budget Office projects this bill would create more debt.
And we're going to incur another $22 trillion deficits over the next 10 years.
This week alone, the U.S. government is flooding the market with $119 billion in fresh debt, $58 billion in 3-year notes, $39 billion in 10-year, and $22 billion in 30-year bonds, according to Reuters. But here's the problem: the world isn't lining up to buy. In fact, foreign central banks are doing the opposite. In February, they dumped $19.6 billion in long-term U.S. Treasuries while pouring $61.6 billion into short-term T-bills instead. The message couldn't be clearer. Global creditors are no longer willing to bet on America's long-term financial future. This isn't a sell-off, it's a strategic retreat, one that's sending shockwaves through global bond markets and raising a much deeper question: if the world won't back U.S. debt anymore, who will? Following the Treasury's $119 billion debt rollout, markets braced for impact. On June 12th, all eyes were on the 30-year bond auction, a key test of investor confidence. At first glance, the results didn't seem alarming. The bonds cleared at a 4.844% yield, slightly lower than some forecasts, offering a hint of relief. But beneath that surface, the numbers told a more troubling story. Foreign participation, one of the most critical barometers of trust, fell to just 65.2%, below the recent average of 67.4%. That decline might seem marginal, but in the bond world, even a 2-point drop can echo across global markets. When major buyers start pulling back, especially on long-term paper, it's not about pricing anymore. It's about belief in America's long game. Meanwhile, short-term debt is still getting snapped up. 3- and 5-year notes continue to see healthy demand as investors seek flexibility and fast exits. But for 10-year and 30-year bonds, the enthusiasm is clearly fading.
So China is dumping all of its US Treasuries and investing heavily in gold. Look at silver also will continue rising. Let's look at what exactly is going on regarding US Treasuries and bonds.
What we're seeing isn't just cautious buying, it's a shift in market psychology. The appetite for long-term US debt is shrinking, and each new auction is becoming less of a routine and more of a referendum on America's fiscal future. What we're seeing in the bond market isn't just a domestic trend, it's a global repositioning. For 4 straight months, foreign central banks have been quietly offloading long-dated US Treasuries and redirecting their purchases towards short-term T-bills. These institutions, once seen as the most stable long-horizon investors in US debt, are now signaling that they no longer trust the long haul. Yes, private investors are stepping in to fill the gap, especially hedge funds and short-term speculators. But that's not necessarily a good thing. These players aren't buying out of loyalty or confidence, they're chasing yield, playing the curve and ready to exit at a moment's notice. This shift from bonds to bills isn't just a preference, it's a defensive move. T-bills mature in under a year, offering an escape hatch if things go south. Long-term bonds, on the other hand, lock investors in for decades. And that's a level of commitment the world seems less willing to make with America right now. When your most trusted lenders start pulling back, it's not about politics anymore. It's about preserving capital in a system they're no longer sure will hold.
Will China and Japan dump their US bonds? And what would that mean? And could that happen? And would that happen? When the United States government needs money, they borrow it. They borrow it from places like China and Japan, but also from investors like us who buy US bonds. And some point down the road, they will pay back the money they borrowed with a little bit of interest. And it's seen as a very safe investment because it's backed by the United States government.
While the world was watching foreign central banks back away, something unusual happened at home. Over just 4 days, the Federal Reserve quietly bought $43.6 billion worth of U.S. Treasuries, including $8.8 billion in 30-year bonds. No press conference, no policy shift, just a massive buy-up that slipped under the radar. Officially, the Fed hasn't called it quantitative easing. Some analysts argue it's simply reinvestment or routine balance sheet management. But the scale and timing have raised eyebrows across financial circles. This wasn't part of the Fed's standing repo operations or scheduled open market activity. It looked and felt a lot like the first steps of a stealth QE. If true, it signals something deeper, that the Fed may already be stepping back in as buyer of last resort. And that raises a chilling question: is the private sector already too weak to absorb America's debt without help? Because if the Fed is quietly propping up the market, it's no longer just about interest rates or inflation, it's about holding the whole system together. And doing it quietly suggests just how fragile that system might be.
You are going to see a crack in the bond market, okay?
Behind every bond auction in 2025 lies a growing pressure few want to confront head-on: America's unsustainable debt machine. This year alone, the U.S. government must roll over a staggering $9.2 trillion in maturing debt, part of a total burden that now exceeds $36 trillion. That's not a future problem, it's today's crisis. Washington is still adding fuel to the fire. A $2.4 trillion fiscal package blending stimulus spending, green subsidies, and expanded entitlements was recently signed into law, even as the country racks up a $1.66 trillion budget deficit for the fiscal year. But this isn't just about raw numbers. What has markets truly rattled is the pace and lack of restraint. In a functioning financial system, rolling over debt should be manageable. But with interest costs surging and investor demand weakening, each auction is starting to feel like a high-stakes stress test. That's why many bond analysts now refer to these Treasury sales as sentiment tests, barometers of how much longer the world is willing to finance U.S. deficits at acceptable interest rates. And the results are increasingly mixed. Markets are beginning to internalize a harsh reality: the U.S. isn't just borrowing more, it's doing so with no clear exit strategy. And when long-term fiscal planning breaks down, trust in U.S. assets starts to erode. Once that happens, rising yields won't just be an economic inconvenience. They'll be a structural threat eating into public budgets, pressuring the dollar, and shaking the very foundation of global financial stability. As confidence wavers and demand weakens, yields are quietly creeping higher, and the effects are starting to cascade through the entire economy. After the latest Treasury auction, the 30-year bond yield jumped to 4%, while the 10-year climbed to around 4.68%. These aren't just technical figures on a Bloomberg terminal, they're pressure points that touch nearly every American household and business. Higher Treasury yields mean higher borrowing costs across the board. Mortgages are already hovering near 7%, making homeownership unaffordable for millions of first-time buyers. Auto loans are climbing too, pricing middle-class families out of basic transportation. For small businesses, refinancing debt or funding expansion is becoming painfully expensive. But it's not just individuals feeling the squeeze. Large corporations are being forced to delay projects/spending and lay off workers. State and local governments, who also borrow using bond markets, are paying more just to fund schools, roads, and essential services. In this environment, rising yields are more than a market adjustment. They're an anchor dragging down economic growth. And with inflation still lingering, the Federal Reserve's ability to step in and cut rates is limited. That leaves the economy stuck between a debt wall and a rate ceiling with very little room to breathe. While Washington scrambles to stabilize its auctions, the world's biggest creditors are quietly repositioning, and their moves speak volumes. Between 2022 and 2024, China slashed its holdings of long-term U.S. Treasuries by 27%, diverting capital into agency bonds, equities, and most tellingly, gold. This isn't a tactical trade, it's a strategic retreat, and China isn't alone. Across the globe, foreign central banks are shifting their reserves away from long-dated U.S. debt, loading up on short-term T-bills and physical gold instead. These are classic safe haven plays designed not just to hedge risk, but to diversify away from over-reliance on the U.S. dollar. This trend, long simmering, has accelerated in 2025. With U.S. fiscal policy looking more erratic and debt issuance ballooning, global institutions are no longer convinced that treasuries offer the long-term security they once did. The symbolic weight of this shift is enormous. For decades, U.S. debt was the anchor of global finance. Now that anchor is losing its grip. In gold, investors see permanence. In T-bills, they see flexibility. In long-term treasuries, they increasingly see risk. And that tells you everything about where the balance of financial power is quietly moving. For years, the bond market was calm, predictable, even boring. But in 2025, that's over. The so-called bond vigilantes, investors who punish reckless fiscal policy by selling off government debt, are back, and their message is loud. In what analysts are calling a reverse conundrum, yields are rising even as the Fed signals potential rate cuts. Why? Because foreign demand is falling, fiscal spending is surging, and investors are starting to demand a premium to hold U.S. debt. The result, long-end yields jumped 70 basis points in just 1 week. According to Bloomberg, an unusually sharp move for such a deep and liquid market. This kind of spike doesn't happen in isolation. It happens when investors believe monetary policy is losing control, when the usual tools-cutting rates calming markets stop working and debt buyers begin to resist. The return of the bond vigilantes suggests something deeper than market volatility. It's a revolt against Washington's unchecked spending, rising deficits, and eroding fiscal credibility. And unlike central banks, vigilantes don't give speeches. They vote with their money, and right now they're heading for the exits. With bond yields rising and auction demand weakening, the Federal Reserve is now standing at one of its most difficult junctures since 2008. Behind closed doors, officials are reportedly weighing emergency tools, reopening repo facilities, restarting large-scale asset purchases, or even resuming quantitative easing as early as September. Publicly, some at the Fed are beginning to acknowledge what markets have already priced. In this is no longer just a rate-setting game, it's a credibility crisis. For Chair Jerome Powell, the choice is brutal. On one side, support the bond market, restore stability, and risk stoking inflation just as it starts to cool. On the other, stay committed to tightening and risk triggering deeper volatility, failed auctions, and a possible collapse in Treasury demand. This isn't theoretical anymore. It's unfolding in real time. If the Fed intervenes, it could be seen as capitulation proof that the private sector no longer wants U.S. debt without a central bank backstop. But if the Fed stays out, it may have to watch as yields spiral, the dollar weakens, and financial conditions tighten across the board. Either way, the Fed's reputation, built over decades of independence and restraint, is now on the line. And the clock is ticking. These days, U.S. bond auctions aren't just about raising money, they're a global test of faith. Every time the Treasury sells debt, it's not just offering yields, it's asking the world a question: do you still trust us? And lately, that answer is growing more uncertain. Foreign central banks are pulling back. Private investors are demanding higher returns. Even the Federal Reserve has started quietly stepping back in. What used to be a routine transaction has become a high-stakes referendum on America's long-term fiscal credibility. If that trust breaks, the consequences will go far beyond Wall Street. Mortgage rates could spike, locking millions out of homeownership. Business loans could dry up, stalling growth and hiring. The U.S. dollar's reserve status could come under pressure, shaking the foundations of global trade and investment. The question now isn't whether the numbers add up. It's whether the world still believes the system behind them is sound. Has the world lost faith in America's long-term financial future? And if that trust slips even a little, how far could the fallout go?